September 1929, Manhattan. A businessman stood by the tall windows of his office, sensing a tension in the air that words couldn't quite capture. For years, the stock market had done nothing but rise. Newspapers called it a golden age. Fortune smiled on America, or so it seemed. Yet beneath the glossy headlines and champagne parties, something was breaking. On a Tuesday morning, guided by instinct and unease, he walked into his bank, slid his passbook across the counter, and demanded every cent he had. $12,000 in crisp cash. He tucked it neatly into his briefcase and went home uneasy but certain. 2 days later, the storm arrived. The markets collapsed so violently that generations would speak of it in whispers. Banks shuttered overnight. People lined up outside, pounding on locked doors. Savings vanished like smoke, but that businessman endured because he held in his hands something that mattered: cash, real and tangible. His decision bought him survival. Now, picture yourself trying that in 2026. You feel the same chill, the same intuition that something is off. You log into your online account. You're 41, your retirement nest egg, and see 180,000 saved over 2 decades of work. You click withdraw. Instead of freedom, a penalty calculator pops up: federal tax, state tax, and the dreaded 10% early withdrawal fee. In an instant, 180,000 becomes a 98,000 before you even touch a dollar. And then comes the real blow. The transaction won't process immediately. It enters a queue set to complete in 7 to 10 business days. Under normal circumstances, during a panic, those business days stretch into eternity. Not because your bank is insolvent, but because modern finance has been engineered to stop exactly what that Manhattan businessman did: escape. That's the real divide between 1929 and 2026. It's not simply about another crash coming. It's about the system itself having evolved to prevent you from doing what every rational person would do when faced with danger. Get your money out while you still can. Your savings are now held behind digital gates, penalty traps, and legal locks designed not to protect you, but to protect the system from you. The great crash of 1929 devastated lives because of leverage and debt. But the next one, the 2026 collapse, will devastate for a different reason. Because no one can leave. The system has become a financial labyrinth, one where exits are illusions. Back then, banking was simple. You walked in, showed your passbook, and got your balance in cash. Same day, no questions asked. There were no processing queues, no identity verification delays, no suspicious activity reviews. If you wanted your money, it was yours within the hour. Stock ownership was equally straightforward. You bought shares and received actual certificates. Ornate paper documents that proved you owned part of a company. You could sell them directly to a buyer or through a broker, and the transaction was settled in 3 days, not 3 weeks. If you sensed danger, you could liquidate and hold cash or gold. That's what many did in September 1929. Those who saw the warning signs early had choices. The tragedy wasn't that the system prevented them from acting. It was that most ignored their instincts until it was too late. When Black Thursday arrived, the ones in gold or cash endured. The rest watched their fortunes evaporate. The system didn't trap them. Their delay did. Now contrast that to today. Try withdrawing 10,000 in cash and watch the red flags rise. Federal laws require a report to be filed with FECEN. Banks may delay your withdrawal for review. ATMs limit daily access to 500 or 1,000, meaning that to withdraw even in 50,000 could take months. In 1929, banks failed because too many people withdrew too quickly. In 2026, banks will survive because you can't withdraw at all. After the 1929 collapse, regulators vowed to build a safer system. But what they really built was a system of containment. One that stops panic not by preventing crises, but by preventing people from escaping them. Every major reform from 1933 through 2010 served this quiet purpose: eliminate the public's ability to cause a bank run by locking their money behind bureaucratic gates. The first cage was disguised as a gift, the 41. Introduced in 1978, it promised tax advantages and long-term growth. Today it holds over $7 trillion in savings, locked away under penalty. Withdraw early, and you lose 35% to 45% of your balance through taxes and fines. Even when you accept that loss, you don't get the money immediately. Requests must be processed, verified, and reviewed. Under stress, those systems freeze, as they did in 2008, when some 41x withdrawals were suspended for weeks. People logged in to find, temporarily unavailable, messages. Their wealth existed only on screen, inaccessible, untouchable. Banking evolved the same way. Cash itself became suspicious. Withdraw too much too fast, and you risk being flagged or delayed. Physical access to your own funds is now treated as a security threat. And investment funds, they're worse. Exchange-traded funds depend on liquidity that disappears during turmoil. In March 2020, hundreds of ETFs traded at deep discounts. A 100,000 investment could only be sold for 80,000, not because assets fell, but because the structure cracked under pressure. Mutual funds can legally freeze redemptions when volatility rises. This isn't hypothetical. The Woodford Equity Income Fund trapped $3.7 billion for over 3 years, paying out just 70 cents on the dollar in the end. Every safeguard that was supposedly built to protect investors has become a mechanism of control. When the next shock hits, and you click withdraw, your request will join millions of others, all pending. The screen will tell you your funds are processing. By the time approval comes, half your wealth will have vanished. This isn't paranoia. It's infrastructure. The walls are already built. They're just waiting for the moment the crowd runs. Why does this matter in 2026? Because the underlying conditions are more dangerous than they've ever been. In 1929, the leverage was visible. 10-1 margin accounts. Today, it's hidden inside derivatives, collateralized loan obligations, and synthetic debt instruments leveraged 20 to 50 times over. The triggers are automated. Algorithms execute millions of trades per second, selling not because of emotion but because of code. When volatility spikes, one algorithm's panic becomes another's trigger, creating a cascade that no human can interrupt. In March 2020, we saw a glimpse of this. The S&P 500 fell 34% in just 23 days, the fastest bear market in history. Trading halts were triggered repeatedly, yet the sell-off intensified once trading resumed. That was just a preview. Now imagine the same speed with today's higher leverage and weaker central banks. You see your 41x fall 30% in 2 weeks. You decide to withdraw, penalties be damned. The request sits in processing while markets fall another 20%. By the time it clears, you've lost half. Then the 40% in penalties hit. From 200,000, you walk away with 60,000. If the withdrawal even goes through. During extreme volatility, administrators can freeze redemptions under extraordinary circumstances. Your account balance becomes nothing more than numbers that shrink on a screen while you wait for permission to act. This is not an accident. It's by design. Banking is no safer. In 1929, the system collapsed because banks couldn't return deposits fast enough. Today, they may not even try. Modern finance runs on digital rails. Fedwire ACH SCUBFT, each has limits, each can jam under stress. We saw this fragility as recently as 2019, when overnight repo rates spiked from 2% to 10% in one day, forcing the Federal Reserve to inject $75 billion just to keep transactions moving. That was during calm. Imagine the chaos under panic. In 2023, Silicon Valley Bank failed in 36 hours. Depositors learned of trouble Thursday, and by Friday, the bank was gone. Those with more than 250,000 in deposits had no access until the following Tuesday. 4 days without money. Businesses missed payroll. Startups froze. That was a single bank. Scale that up to dozens, and the FDIC's $125 billion fund will barely dent the $10.5 trillion in deposits it supposedly insures. The math doesn't work. The safety net isn't big enough. Interest rates are already near their limits. The Federal Reserve's balance sheet is swollen from years of quantitative easing. Government debt surpasses $35 trillion. There's no ammunition left, so when the 2026 collapse comes, it won't just be deeper. It'll be faster. Because this time, there's nowhere to run. The warning signs are already glowing, though few pay attention. Corporate insiders. The executives who actually see company books before the rest of us are selling their own shares at historic rates. In late 2024, insider sales hit $16 billion in 3 months, quadruple normal levels. Sovereign wealth funds are quietly shifting out of U.S. equities into gold, commodities, and short-term bonds. Norway's pension fund cut stock exposure by nearly 20%. Abu Dhabi boosted gold holdings to their highest levels since 2008. These are not emotional moves. They're calculated. Meanwhile, liquidity in the U.S. Treasury market, the backbone of global finance, is thinning. Bid-ask spreads are widening. Orders that used to nudge yields a few basis points now swing them by 20. That's what happens before systems seize. Even the safest assets are showing cracks. And yet the headlines remain the same. The economy is strong. Corporate earnings are solid. This time is different. It's never different. Before the 1929 crash, the Shiller-Peak ratio stood at 32. Before the dot-com collapse, 32 again. Today, it's 39, nearly a quarter higher than both those peaks. But somehow investors convince themselves that AI, automation, and innovation justify valuations history would call madness. Even the yield curve, inverted for over 3 years, screams warning. Every recession for the past 7 decades followed that same signal. We're 39 months past the trigger. The clock has already run out. The danger isn't that we're repeating 1929. It's that we're doing it without exits. When 1929 came, at least people had choices. They could withdraw cash, hold gold, or wait out the storm. Today, those exits have been sealed. Insiders and sovereign funds are already moving quietly. Ordinary people, meanwhile, are being told to stay the course, keep contributing, don't panic, ignore short-term noise. They are being positioned as exit liquidity, the last ones holding the bag before the system closes its gates. History never repeats perfectly, but its rhythm is unmistakable. Every bubble begins the same way: optimism, leverage, and the illusion that this time is new. The only difference is speed. In 1929, it took months for panic to spread. In 2026, it will take hours. There's a simple truth people forget: the markets are built on belief. When that belief cracks, it happens instantly. The businessman in 1929 survived because he acted on instinct before the crowd. He didn't wait for official confirmation. He didn't seek permission. He didn't need to fill out digital forms or wait 7 business days. He walked in, withdrew his cash, and stepped aside as the system imploded. You don't have that luxury anymore. Today's world runs on screens and promises. Digital numbers that can be frozen, delayed, or taxed at the worst possible moment. The system's first loyalty is to its own survival, not yours. But you still have time, a shrinking window, to act with foresight. You can shift contributions away from locked accounts. You can build liquid reserves outside the retirement maze. You can accept smaller taxes now instead of catastrophic losses later. You can watch what insiders are doing and mirror their caution. Or, like most people, you can believe the story, that this time is different, that the central banks have it under control, that technology will save the system, that markets always recover if you just hold on. Every generation has believed the same comforting lie. The 1920s believed in industry. The 1990s believed in the internet. The 2020s believe in artificial intelligence. The costumes change. The story doesn't. Those who survive the storm aren't prophets or geniuses. They're the ones who see the pattern early and act when everyone else still feels safe. They look foolish until the moment they don't. The traps are already armed. The signals are already flashing. The exits are already closing. Insiders are already gone. The only question left is, will you be trying to escape through doors that no longer open? Because when the crowd finally moves, it will be too late. The system will freeze. The numbers will fall, and what you thought was wealth will become just pixels on a dimming screen. Your grandfather's generation could grab their money and run. You can't. Not anymore. But you can still decide where you'll stand when the cage locks. The choice is yours. The clock is ticking.